Hello guys, welcome back to the channel Gyaan Valuable. Today in this video, in the episode 2 of search for multibaggers. So we are into another company which is a small cap and a micro cap company which is KSOLVES India Limited. So in this company, I will just use again the AI feature on the screener.in. So we'll just understand what is the business model of this company as we do in all our researches. So let's So you can see here there is a business models of KSOLVES India Private Limited. It says it's service-led, product-augmented business model focused on next generation digital transformation services, niche technological solutions. It's into services, and there are only 2% of its products. So partnering with SMEs for mutual and concurrent value creation, small and large cap proven value. So what actually they does? Revenue is recognized time and material unit of work fixed price. So KSOL generate through high margin IT services and emerging product sales. So the services are, you can see here, around 31, 13, 1. They help the businesses to set up these services or take these services and get implemented in their businesses. I think that's the thing, that's the work which they do. So they have 170 software. So they have tied up with this Odoo, Salesforce. These two are the major, that is the software providing services company, and they partner with them and they acquire clients for these service providers on behalf of them, and they get a revenue percentage share of from Odoo. So I think that's the only business they do. And niche expertise, big data, Salesforce, Odoo Gold, okay, debt free company. So yeah, so this is the basic thing. They are a service providing company which are mainly collaborated with Odoo and there is the Salesforce. So these are ERP software providing companies, like you can say the Oracles, like Tally. So these are the accounting software provider Odoo. So they like Zoho. You also be aware of Zoho, how the Zoho functions. So they have multiple ERP softwares providing to the businesses, catering the each and every areas of the functioning of each department within an organization. So uh, this is what the business model of KSolves look like, and let's see the fundamentals. We'll go into the balance sheet first. So balance sheet available is as on September 2025, and so the earnings reserves, you can see there is no major reserves, so they are not retaining their profits. I think they are just utilizing their profits to buy assets or distributing among the shareholders through dividends. So that is why you can see the reserves are not growing in a good manner. So it's a very small amounts which you can see here, and the borrowings, there is nothing, and other liabilities, that might be trade payables and other liability, and fixed assets, you can see here. Okay, there are nothing here in this list. Okay, so there are no fixed assets left. It says 6 crores. Okay, and other assets, so major trade receivables, cash equivalents, so 17 crores of cash equivalents. And what else in the cash flows they have? They have 34 crores in the cash flows in the March 2025. Then cash from financing activities, so they have distributed dividends, I can see here. So the reserves are low. So where the funds are going, either it should go in the fixed assets or it should be distributed among the shareholders, and they are distributing it among the shareholders. So you can see your major components are being distributed. So this company should have a high dividend yield comparatively. So it has 5.34% dividend yield. So it's a good sign for in dividend, that is for dividend yield investors. So so when you see the company who is distributing more dividends, it means that the company is not more focused in the growth aspect of the company. They are just thinking they have been stagnated, or they have achieved a cash cow stage where they are not trying to expand the business. So if the money is within the company, then that money is will be used for expansion purposes. So here, if you see the dividend distribution, which it implies that the company is not more that is interested in that is in the expansion of the business, rather they are just taking out the profits from the business. Okay, so that would be a negative sign. And so the growth companies, so this might not be a growth company anymore, so that's the reason. And these are the shareholdings. You can see FIIs have drastically reduced their portion, and now it's around 0.10, and even DIIs are not at all holding anything. So this is also another sign that there is no growth aspect left in this company. So let's ask AI and just confirm whether what we have analyzed is right or not. So what is the growth aspect of, let's see how AI will react on this. the one which we have analyzed it, it says there is no major expectation from this company. So let's confirm with AI. It will review all the available documents, that is the annual remis, starting small with large enterprises, high impact projects. So they are going to start with MSMEs, SMEs sector. They need to partner with small businesses to get implemented for these services. So likely or not likely, this might not be so attractive business. It's a challenging one. It is a very that is a positive thing that the company is trying to expand the business, but with the available two three services or the two three service providers, and you want to so you are completely dependent on the services provided by these three. So let's note that steady double digit year on year momentum from Odo are client wins, but margins compressed by ESOPs. We have that everything goes well. Management are positioned for sustainable 20 to 30% growth via services stability plus products upside backed by strong fundamentals. So they are aspiring for a good growth, but we need to be very cautious in the upcoming quarters. Higher end targets imply greater than 300% upside, lower 30%. No official financial year 26 targets, but depends on the Q3 results, which is due soon. This is what I'm saying. So it's all dependent on the company's performance, how they are going to acquire new clients, how they are going to sustain the margins which they have right now. So they say that 25 to 30% of margin is expected by in the financial year 26. So if that happens, then definitely the positive bull case scenario which will be there, you will can achieve 50 to 30, 50 to more than 50% of return in this company in over the 1 year. So summary, if you see financial year 26 guidance met, if these are met, that is 20% growth they should achieve in the revenue and pipeline converts, then 20 to 40% upside will be possible on execution. Monitor Q3 results. That is what I'm saying. Q3 results will be more fun, more important for this company, because then high beta small cap suits the growth investors. Volatility expected 20 to 30% swings. Yeah, that is expected here. So it will be a roller coaster stock, but it has historically given good returns. So let's hope for the good thing to happen in this company. And you can see the price performance over the past years. So it's been a good returns in the 2023-24. I think there was a split happened in this year, and now it has been reduced to 290. So this is a very low price at which it is trading right now. And the PE ratio, you can see the mean was 30.9. Now right now it's around 24, I think 22. It's a very low value, and so let's see what happens. And we'll be tracking the quarter three results. So what should happen in the quarter three results? It should be at least 50% of this amount. That is, the current value is 30-40 crores of sales. So 40 crores into 20%. So it should be around 50 crores of that is quarterly revenue should achieve a constant 50 crores, which is a very challenging one for this company. But the profits margins they have continuously maintained around 37 earlier. Now the profit margins have also reduced to 30%. So that might also be the reason of the fall in the share price over the last 9 months or 1 year. So the net profits have also impacted from that, but in the recent times the net profits are trying to increase. So it might be a components from these other incomes, but still the company should try more to achieve good great heights. Not so exceptionally good stock, but a stable and a high risk investor can invest in this company with very low that is distribution in the portfolio you can allot to this stock. So that is my analysis, and this is not a suggestion. So do your analysis and make your investment decisions on your own. So thank you so much for watching this episode number 2, and welcome again. We'll be seeing the next video in the upcoming episode with a new company. And please subscribe to the channel and like the video, share the video, and please comment in the comment section if you want any more additional information from my side on this company's whatever I'm analyzing. So or any improvement which I need to do. So please comment and suggest. It's very important for me. So thank you so much. Bye bye. Take care.